Alright guys, glad to have you on board again today. Wednesday is time for a flow sequence updates and also looking at a range-based kind of arbitrage type strategy. Just go easy in and out, figuring out time frames which you can blindly trade on, applying the dumb strategies and or third range boundaries. So here is what we're at regarding as of last week. We have now entered into the big selling area which we were expecting us to be, so we're in. That means right now there is nothing you can do but looking for resistant trade. You don't buy in a sellable area. So that's the number one rule. We're in a monthly resisting area. So you don't trigger a single buying entry. For whatever reason there is, you can't buy there, all right? So it's sell only. But to sell out of a market top, making new all-time highs and the like, is simply not going to be as easy as it sounds. So you never sell a market top. Remember that. The strategy never tells you how to find a market top. Otherwise, you're simply bending the rules dramatically. So it's experienced traders only to figure out reversals trade and stuff like that. Until then, this is nothing like we do here. So stick to the essential, making new all-time highs, wait for it to reverse, okay? For those who were trading this flow sequence in the H1 time frame, we figured out a third range boundary in here. This one was out of the volatility alert. So frankly speaking, you should have taken your profits out there, which means for the H1 flow, you should be out of this. You should have been taking profits so far, which means you no longer are bullish. We're in a 4-hour bearish area, which means you're going to have to wait for a first bearish flow to happen, and that requires the moving average to flatten as the bearish context crosses it below. Like we stated before, it's very less likely to happen, technically speaking, until somewhat like March or so. So be very cautious with that. If you fully want a bearish flow trade in the S&P 500, well, pretty much not until Q2. The second thing that we know instead is that despite having a flow sequence, the only thing you can eventually try to attempt is to know that the reference time frame is 4-hour chart. So anytime you have something like that, remember you've got an open of the Bollinger Band, both of them kind of diverging, and then both of them starting to converge, which is what they do now. Okay, you know that you can trade the 4-hour reference 2.5 standard deviation. So I would tend to say, remember, you can't buy. That means if prices are above 9,900 or so, you can't buy. So for now, this lower Bollinger Band is below that threshold. So you could buy 47.93, pure volatility arbitrage trade. And remember, you sell it all and reverse the position when you hit the opposite boundary. And you can just play that ping pong game for multiple times. Remember that anytime you will get a lower Bollinger Band inside that red area, God damn it, don't trade, okay? You never buy in the selling area of the low risk strategy. That would be just absolutely outrageously stupid. So that's TLDR for the S&P 500. If you want to blindly trade the shorter time frame following the flow sequence, I would tend to say you know the reference time frame is monthly, so 4-hour charts volatility can eventually be considered, but that's really all by itself kind of starting to bend the rule. Normally, you're supposed to have a flow sequence in front of you to be able to trade these things. In here, you don't have any such a thing. So that would be kind of saying, not knowing what to do until Q2, I can blindly attempt to trade volatility. But number one assumption, if you do this, be very careful with position sizing, okay? That's really the way I would say. Don't ever go 2% risk taking in these kinds of trades. You're really bending the rules. That means we're simply trading in an area in which if we climb our way higher, there will be no way to support the market, no way to buy. There will be selling activity only. And you can clearly use the Bollinger Band strategy here. It's not perfectly suited and therefore comes with higher risk taking in here, but that's the best assumption you could come up with. And it's literally starting to bend the rules. To say we don't nearly have any flow structure going on in the 4-hour chart now, but we can still try to arbitrage volatility there. The number one recommendation for me is to instead go with the flow and to say, try to trade the short-term ranges that could emerge. This thing is very likely going to neutralize, whether we touch Bollinger Bands or whatever. You figured out one out already. It's pretty much the same thing. Whether you trade with volatility or you're going to trade with Bollinger, range reversals and stuff like that, wait until it reverses. I mean, just look at that. The whole fucking set of time frame is bullish. So just let it neutralize. And whenever it neutralizes to sustainable enough time frames, I wouldn't recommend 15-minute trades. But let's say if it neutralizes H1 again, you know what to do. That means prices need to retrace down to the support context, reverse it, and you'll be able to trade it. That will be the trend channel here, okay? So that's the way to go. Wait until something happens. And when something happens, you know a third range boundary will be followed through, and then you can dump trade in this area multiple times. That's really the way to go. I would recommend to be very cautious on the S&P 500, not trying to find the top whatsoever, okay? But anytime we go 2.5 standard deviation for our chart time frame, Jesus, just go in. That's a simple risk taking. You know how much you're risking. You know how much you can make. It's generally 1-to-1 ratio. So take your bet. That's really the way to go. Really, really pay that one great attention. If you ever pull any buying activity anywhere above 4,900, good luck with these trades. I would never do this. Whenever we switch to cryptocurrencies instead, that's going to be Bitcoin. In here, we're in the 4 hours reference charts. And as you can see, when we look at the flow sequence here, this is flow sequence number 2, okay? And we are now reversing the context. We're not yet there because if you look at the median, you would see it is still blue despite the recent attempt last week. So this one will update by the end of the week. And therefore, I'm very curious to see. We've dived below, okay? Remember, we've broken the context. So we're clearly going to have to pay real attention by Sunday. 2 things will happen. If by Sunday we're still trading somewhat in the nearby area, of course, the context will reverse and adjust. That means third range boundary will be traded out there, and that will be the end of it. Remember, this second flow has reached maturity. We need to take our profits and run away. So if the third range boundary is there, probably in the following weeks, and that doesn't have to be next week or the week right after, weeks. And remember, you don't control time, but you know a third range boundary will play its game out of there, and that's where you take your profits. Remember all the trades we've taken back then? This is where you take them in. You take them out. You take your profits. Okay, so that's really the way to go. That doesn't guarantee this is going to be the market top. Very, very important thing to remember all along is to say, well, a third range boundary is just a signal for you to get the hell out, and you need to get out, not trying to figure out, because sometimes the third range boundary will be broken and squeezed, pulling new all-time highs, new high highs afterwards, and therefore that means, well, you've got traded out, and potentially later stage the third range boundary will show up. So there's no way for you to know where the market top will be. All you know is that if third range boundary shows up, I'm out, period. That's really the way to go. That's how I navigate Bitcoin. But as you know, I've moved my Bitcoin trade to Ethereum, which is in a quite similar position. Ethereum in here has made a false flag by going to the context. And remember, we said there could be a risk of a third range boundary to be delayed here, but don't ever call that before it actually breaks the previous low point, didn't, made new highs. Very simple. But in here, context to context, very brutally, same thing goes in here. By Sunday, we'll be able to figure out if the context is reversing or not by changing the color of the median line. If the median line sticks to the blue color, that means, well, the best you can get is a delayed third range boundary. So just like it was there, don't be too much of a bear. Potentially start taking some partial profits. One could easily argue that if Bitcoin reverses its context but not Ethereum, well, you could definitely say, yeah, maybe Ethereum will strike a delayed third range boundary, so I would like to score some gains in here. So that's going to be it for me. I don't know. Only thing you know, for a delayed third range boundary, it needs to go from context to context without reversing, which is exactly what we have now. So if by Sunday this remains blue, that means the only way for a delayed third range boundary to happen is to retrace at least to the trend channel and break it. So you know that your taking profit will be higher than the trend channel. That's really the way to go. Okay, so expect it to be somewhere like 25 or so. All right, and only partial profit taking. Remember, delayed third range boundary can't be forecasted ahead of time. It's just, you're going to have to react if that's the way to go. Also, one thing you know is that if there is a delayed third range boundary on Ethereum, we'll get back there afterwards. All right? And anyhow and anyway, at that point, your trades need to be at break even. So don't be like these people who say, yeah, I have some nice gains. I want to take it all out now because I could lose them all. No, yeah, you can lose them all. Be aware of that. It can happen, and it will at some point in time. But the thing is, you can't bend and break the rules just for these kinds of assumptions. Most of the time, you have played these things in replay, and you've seen that when the delayed third range boundaries show up, the prices go back there again. So try to work with that assumption. Don't be too bearish. Ethereum doesn't show any signs of bearishness now, despite what I see here and there on the social medias. So be very cautious with that. Moreover, Bitcoin could very well keep building V-shaped reversals on this area, just a sign that we're building this kind of washing machine type of trades, which means, well, we're just blindly creating absolute stupid volatility while still performing pretty well overall. That means despite your ability to perfectly time the market in and out, you can still hit yourself ride that trend as it goes up. The value is increasing as the time is. So that's really the way to go for Ethereum and Bitcoin. So just be aware of that. Until the context is reversed, there's no way for you to know. The only pending risks when you go from context to context is the delayed third range boundary. You can partial profit take eventually if you're really scared out, but that's not the way to go for a full profit taking ahead of time. Just if you did it the last time around, well, you would have regretted it. Okay, so frankly speaking, once again, don't limit your gains when you flow sequence trade. If you go down the path of, yeah, I don't want to sequence the flow or whatever, I just want to blindly trade volatility, H1 time frame is now perfectly suited for Ethereum to build. So as you know, that's the same story if you want to trade H1 time frame. Okay, let's move it to here. Okay, from now on, here's how it's going to be. Okay, remember, first and foremost, 4 hour will neutralize over time. So long as it is bullish, you can trade H1. Just go for it. Okay, right now you know what that is. Okay, you know that we have closed below the falling context, below the context. So right now there are significant chances for this to be traded inside the context. Okay, so bear that one real attention. 61% retracement inside the context should be somewhat like 2,500 or slightly below. Be very cautious with those areas. Okay, this is where, if there are bearish signals, you really want to be eventually trading a bearish third range boundary. Okay, so that's really the way to go. And remember, that's just one of many trades. But the bearish third range boundary requires some profit taking, requires some risk management, and all those sorts of things. Let me just figure it out by bringing up the Prezi. I think the Prezi here is in France, but still, it's going to be more than nothing. Give it a second to show up. All right, here it is. Yeah, sorry, it's in French, but that's basically the way to go. You'll go for range, where we'll be in a third range boundary. Remember, this is going to be this one. This is the trending third range boundary, and these are all the signals you need to gather to get a full 2% maximum risk taking, okay? You can get less than that, but at least, bare minimum, you need to check at least half of the conditions, okay? So that's really the way to go. You need to have a second range boundary that closed below the context, which we have said is already a check, okay? You need to reverse inside the context, so bear that one in mind, and minimum 61% Fibonacci. So put your fibs, figure out what a context is. If prices reach out the context, minimum 61%, and show some sort of triangle of confirmation with a momentum signal, well, eventually you can start doing something, okay? And that's really the way to go. If you have an additional sine wave breakout, that's only a premium for your risk taking. So that's really the way to go, okay? It's really how it is. So you know how to pull that one out. You put your fibs, okay, top to bottom. Of course, remember, if you make new lows, adjust the fibs accordingly, okay? The bearish third range boundary, as of right now, would be bare minimum 25.07, and that's really the way to go. If you want to trade this inside the context, as you can see, it's probably gonna last for another couple of days, and then we'll be above the context, which means not tradable enough, and there you're gonna go for the neutral one. If that sounds crazy to you, what I just said, that means you need to learn some few things with the third range boundaries, okay? But that's really the way to go. That's what I would say. For Bitcoin, this seems to be pretty much the same context. Let me just see if it is. Yeah, it is. So same thing in here. You can trade the H1 range. That's pretty much the same strategy here. So bear that one in mind. Okay, you can, if you don't want to flow trade, just trade blindly the range you have in the H1 time frame. As they were preceded by bullish trends, we go for third range boundary trades. That's the way to go. Okay, so pull that one very simply. Don't put too much weight on your shoulder. Just trade what you see. Don't listen to other people's noise. Okay, really, TLDR #1 rule in trading. If you short-term trade, don't listen to the noise. Don't listen to the news flow. Don't listen to the medias. Don't listen to social medias on top of everything. That's the way to go. Trade what you see, be dumb, and repeat. Okay, I'm going to leave you guys with that. Eventually, yeah, I did it for the French guys. I'll do it as well for you. So quick look at the commodity markets. Remember in here, our flow sequences are very, very large time frames. Can barely figure it out because as we can see, the daily reference, which be into quarterly ranges, as you can see, the flow sequence are very, very excessive. Kind of leading me to believe that, well, it's hard to figure out the reference time frame in here due to the long history we have with those assets and the big ranges which we're in. I mean, one would easily argue that, yeah, quality based is clearly a range, but one could easily say, well, daily is yearly could be as well. So I would then say daily seems a bit excessive. So remember, we need to assess the probability of both to actually be the truth, and we need to let ourselves open to the fact that, well, daily might be a bit excessive, but the weekly chart could be delayed, which means giving you signals too late. So bear that one in mind. If you were taking the weekly context, you would need a third range boundary there. That means you have your first flow, the moving average did close, the context did cross over the moving average, which was flat or rising, though, which means in here we would eventually go for a third range boundary, and then and only then we would be able to buy the moving average. That means in this weekly reference, we would still need to do a third range boundary trade somewhere around bare minimum 104, which would be 61% retracement. Okay, that means we would be rejecting $100, pulling right back down to somewhat like 80 or so, just finding the moving average again, somewhat late 2024 or 2025, and we would trade again bullish. That's for the weekly reference. Now, if you're in the daily reference kind of stuff, well, you would say that in here, of course, the signals have been very aggressive. Let me just show it to you. Switching to Bollinger Band mode, you would have been, for example, in here, having a delayed third range boundary in here because the context have been messed up. And you basically would have been traded the moving average and or the Bollinger Band. We've gone very close to the Bollinger Band here, but not touching it perfectly. So be very cautious. The Bollinger Band is updating each and every month. So earlier next month, we get a new Bollinger Band. It's very likely going to be in contraction, though very curious to see if the market early next month is going to go there, just kind of a trap market for the bulls, just going there, finding the Bollinger Bands, and then violently reacting. If that's the case, well, once again, you had all the prerequisite elements to do such a thing. You know, daily is a viable context for flow sequences to be traded. Okay, so that's the world as it is now when it comes to commodity trades. It's really the way to go. I think we could have a somewhat of a drop in the USD WTI. God knows what could trigger it. I think the only thing that it would do is just trap some bears, get to the Bollinger Band, and violently reverse afterwards. Just for the sake that we haven't gone to that Bollinger Band yet, we could very well do it. Okay? On the other hand, if you're trading the weekly, well, we have traded the moving average already. Prices could very well hold these lines strong. If you want to trade this in the shorter time frame, though, it's going to be... yeah, nothing for now. 15 minutes is very, very short in time frame here. So wait until the resolution of 4 hour or H1. As you can see, bearish 4 hour, bullish 1 hour. One of these two is wrong. We'll see which one it is. And depending on that, you will be able to trade the one that gets broken out. So that's really the way to go. When it comes to silver, remember in here, it's pretty much the same situation, which means we could both play the daily and the weekly. They're both acceptable type of strategies. And it's hard to figure it out because in here, the difference is we would have had the delayed third range boundary already, would have been there, which means in here, buying the moving average is eyes closed. So just like we've seen, when it comes to WTI, okay, the weekly still doesn't have a third range boundary. We do have it for silver, okay? So it could very well be the weekly reference for both of these assets, but you need to trade what you see. Don't ever play the game of correlating assets for whatever reason. It could very well be the case, but you can't stand that line. So stand to trade what you see. WTI in a weekly chart doesn't yet have a third range boundary, so we need to eventually go $100 first before you buy the moving average on the WTI. For silver instead, we did have that third range boundary. You needed to buy the $18, and now you're waiting for the prices to break 29. That's the way to go, okay? And anything else that you do now is trading short term. You know that you can do it eventually in the 4-hour chart or somewhere like that. Just have a look at those time frames. This is probably where you'll figure out some ranges to trade, okay? That's just basically the way it goes, okay? Silver seems to me that it gives us a more reliable context to trade, as we already have the third range boundary. We just need to get through it and to break the previous highs, which are 29, to get confirmation of these second flow being triggered. That's basically where the first one guaranteed. We've traded the moving average. We're all granted now for a second flow to break the previous highs and keep going so long as it doesn't build a third range boundary afterwards. Okay, so like we stated, yeah, commodities and particularly silver could be a very, very interesting asset in the coming month. But until then, the retailers are piling like crazy to buy it. So you know what it is. It doesn't make it any easier for the market makers to release the pressure. And if you want to trade the short term, well, look for those ranges. Okay, so for now, 4-hour chart, yeah, it's overly mature in here. And you had another nice buying entry in here below the context and stuff like that. So that's pretty damn how it goes to me. Remember, we're still in the daily range as well, and the monthly, and so on, okay? So that's really the way to go. Ranges, inside ranges, and as you can see, this is just a big mess in which the brokers just enjoy manipulating your sentiments. So that's how it goes for me. Be very cautious with that. You can still trade 4-hour in here, as it is multiple ranges, one into another, into this thing. 15-minute, clearly, please don't do such short-term time frames in commodities. Okay? That's the way to go. We have it all. See you guys next week. Bye-bye.